Mid and small cap funds are among the most sought after investments, and there's a good reason for that. Mid and small cap companies have a higher return potential than large caps, but they come with a problem, and the problem is they're highly volatile. And so most people invest in mid and small cap funds looking at past returns, only to realize during choppy markets that they can't tolerate the wild swings in the investments they have in these funds and exit. And that's why even though you see some astonishing returns of funds in these two categories, only a few investors make that kind of returns. So is there a better way to take exposure in mid and small caps? Hello and welcome to ET Money's channel. Today we will analyze whether multi-cap funds are a better way to take exposure to mid and small caps, and can multi-cap funds give you higher returns like mid and small caps with lesser volatility. And this analysis is quite unique as we created our own proxy multi-cap fund since there isn't enough data on the performance of multi-cap funds. So stick around. Now you could be wondering, why are we looking at multi-cap funds as a substitute for mid and small cap funds? There's a good reason. Let's first understand that. There are some mutual fund categories where the fund managers have complete liberty to invest anywhere they wish. Depending upon the market conditions, they can invest in large cap, mid cap or small cap stocks. And so they have the flexibility to invest a large chunk of your money in mid or small caps if they wish. Now there are 7 such categories: flexi cap funds, multi-cap funds, large and mid caps, ELSS, value or contra funds, focused funds, and lastly thematic or sectoral funds. However, of these, only 3 don't have restrictions in terms of the lock-in, number of stocks, investment philosophy, and investment process. These are flexi cap funds, large and mid cap funds, and multi-cap funds. We have now zeroed it to 3 categories. Let's talk about them further. Flexi cap funds can invest in companies of any size in any proportion. Multi-cap funds must invest at least 25% in large, mid, and small caps. And lastly, large and mid-cap funds must invest at least 35% each in large and mid-caps. They are not mandated to invest in small caps, but they have room to do so. In theory, these 3 diversified categories can get you exposure to mid and small caps. They don't have any other restriction, but things are not as simple as they seem. The data on your screen has the flexi cap category's average allocation to different market caps at the end of each quarter since 2020. Now, as you can see, their large cap exposure has averaged around 66% over the last 3 years. So by the looks of it, they don't invest a big part of their corpus in mid and small cap stocks, and therefore might not be the best category if you're looking for decent mid and small cap exposure. Let's now talk about large and mid cap funds. Thanks to their mandate, these schemes do have a sizable allocation to mid caps, but their exposure to small caps is quite low. It has averaged just 7.42% over the last 3 years. So this leaves us with only multi-cap funds. With their mandated exposure of at least 25% in all market caps, these funds will always have at least 50% in mid and small caps. And this is the reason why they could be a good proxy to invest in mid and small cap stocks. That's what it feels, at least in theory. Now, one more reason why we decided to analyze the multi-cap category as a good proxy for investing in mid and small caps is their recent returns. Now, in the past 6 months, there has been a rally in mid and small cap stocks. This is reflected in the returns of not only mid and small cap funds, but also in multi-cap funds. Now, here are some numbers. In the past 3 months, the average returns of multi-cap funds have been about 14%. Mid-cap and small-cap funds have given about 16 and 17% respectively. And if you compare multi-cap category returns with other diversified categories, you will see why we think they could be a proxy to mid and small caps. In the past 3 and 6 months, they have had highest average return across all categories. So there is a trend. So we decided to look deeper into it. But before we go any further, it is essential to know a few things about these funds. We don't obviously expect multi-cap funds to beat mid and small cap funds. Multi-cap funds have a good allocation to large cap stocks, so they may or may not do better than mid cap and small cap funds. But with over 50% in mid caps and small caps, we wanted to see if multi-cap funds can participate in the rally, giving investors higher returns and achieve higher returns with lower volatility than mid and small cap funds. But first, let's have a quick look at the background of multi-cap funds. The history of multi-cap funds is quite confusing. These funds have always been there if you just go by the name multi-cap. The category has been there for a while and they were allowed to invest in companies of all sizes and proportion. However, most multi-cap funds were large cap heavy and had minimal mid and small cap exposure. They weren't multi-cap in essence. So in September 2020, SEBI came out with a rule that multi-cap funds should be true to label and therefore must have at least 25% each in large, mid and small caps. But this move created a problem for the industry. Many multi-cap funds at the time had big allocation to large caps, and shifting that to mid and small caps to comply with the revised multi-cap mandate would have caused quite a lot of issues. So SEBI introduced the flexi-cap category, and most AMCs reclassified their multi-cap funds as flexi-cap funds and then launched new multi-cap funds. In short, what were multi-cap funds earlier are now known as flexi-caps in most cases. The multi-cap category currently has 21 funds. Now let's go back to analyzing these funds. Given that this category is new, we had to develop a special method to assess multi-caps. Let's understand what it is and how we did it. Since there is limited data on multi-caps, any concrete analysis was not possible. So we decided to simulate the performance of a multi-cap fund. It means that we created our own multi-cap fund and then studied the performance of this multi-cap fund for the long term. This will give us a fair idea of what to expect from multi-cap schemes. This fund that we created is similar to the existing multi-cap funds. Let me explain how we did it. First, we used 3 indices to create this multi-cap fund. The 3 indices are Nifty 100 TRI, Nifty Mid Cap 150 TRI and Nifty Small Cap 250 TRI. Because equity funds also have a cash component, we took SBI Liquid Fund as the proxy. SBI Liquid Fund is the largest liquid fund as of June 2023. It is also one of the oldest in the category. Next, we had to decide in what proportion these indices should be in our multi-cap fund. To find that, we looked at the average market cap allocation of multi-cap funds over the last 2 years. Now, on the average, multi-cap funds have invested around 42% in large caps, 26% in mid caps and 27% in small caps. They have about 6% in cash. So we decided to use the same asset allocation for our proxy multi-cap fund. And to maintain this allocation, the proxy multi-cap fund was rebalanced on January 1st of every year. And then we studied the performance of this proxy multi-cap fund against the Nifty Mid Cap 150 and Nifty Small Cap 250 indices between June 2013 and June 2023. So what did we find? Let's see. We will start by comparing the returns of our proxy multi-cap fund with those of Nifty Mid Cap 150 and Nifty Small Cap 250. Let's start with the trailing returns. See the chart on your screen. While the proxy multi-cap fund didn't come out on top every time, it was able to outperform the small cap index across 5 and 7 year periods. The mid-cap index has had the best run based on this metric. It appeared on top in 3 of the 4 periods. Now, another useful parameter for measuring returns is rolling returns, as you measure performance across time for all possible combinations. So, in the case of 5-year rolling returns, it will be across any 5-year period over a specific time band. The chart on your screen shows the average, maximum and minimum returns of the mid-cap index, the small cap index and the proxy multi-cap portfolio. As you can see, while our multi-cap portfolio did better than the small cap index in the terms of average 5-year rolling returns and minimum 5-year rolling returns, the mid-cap index has again stolen the show. So the proxy multi-cap fund is quite a competition for the small cap index. However, as compared to mid-cap index, its performance is wanting. Now let's talk about the volatility of the multi-cap portfolio vis-a-vis the mid-cap and the small cap indices. Now, discussion of returns without looking at volatility is only half the picture. In an ideal world, you want high returns with no volatility or absolute certainty. Sadly, that doesn't happen. Often, the higher the return potential, the more volatility is involved. Now, we check the volatility of 5-year rolling returns by looking at the standard deviation. The higher the standard deviation, the higher the volatility. Now, see the chart on your screen. The proxy multi-cap portfolio has significantly lower volatility than the small cap index. While it's also lower than the mid-cap index, the difference is narrower. So overall, the multi-cap portfolio is less volatile than the small cap index, but almost as volatile as the mid-cap index. Now let's move to the final parameter, downside protection. So we wanted to check if the multi-cap portfolio offers better downside protection than mid and small cap indices. To do so, we first defined what a downside is. For that, we considered those quarterly periods over the last 10 years when the Nifty 50 gave negative returns. We then checked the returns of the proxy multi-cap portfolio, the mid-cap index and the small cap index across all such quarters. The table on your screen shows the result. Out of the 11 periods, the multi-cap portfolio did better than the mid and small cap indices in 6. That's more than 50% of the time. Next comes the mid-cap index, and the last, as you may have expected, is the small cap index. So overall, the multi-cap proxy portfolio provided decent downside protection thanks to its decent large cap exposure. Now with this, we have come to the end of this analysis. So what's the aggregate picture and what should you do? Well, that's the concluding section. The table on your screen summarizes our analysis. So the proxy multi-cap fund has a competitive return profile with respect to small cap index, but is not as good as the mid cap index. In terms of volatility and downside protection, they are better than both the mid cap and the small cap indices. Overall, the proxy multi-cap portfolio has provided decent performance with comparatively lesser volatility and better downside protection. Does it mean you should invest in multi-cap funds? Our study was based on some assumptions, which we have mentioned at the start of this video. It's very likely that the real world experience will be different. For example, we rebalance the portfolio once in a year. In real life, fund manager has no such obligation. Also, we took the average asset allocation to determine index weights in the proxy multi-cap portfolio. In real life, funds can have different asset allocation and a fund's asset allocation can change across the spectrum. So don't expect that you will get exactly the same results in real life as it in this study. Consider it to be indicative. Some funds will do better than this and some will do worse. But one thing is clear, don't write off multi-cap funds. They can be a good option to take exposure to mid and small caps, reduce volatility and get better downside protection. More importantly, they could be a useful option to allocate assets across market caps so that you always have exposure to all market caps. Now, such a thing is not possible with flexi cap, large and mid cap and other diversified equity funds, as they tend to be skewed too in terms of market cap or investment philosophy and approach. And with this, we have come to the end of this video. If you found it useful, do share it with your friends and family. And I will meet you next in a few days from now. Till then, take care and bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.